Hi, this is Nahid Rani. I'm going to say something about the Learning Outcome 3 of our Finance for Strategic Managers, which is our Level 7 ATHE course. So today we are going to discuss about sources of finance and the cash flow management technique. So if you see our unit specification, we have four learning outcomes, and then on our learning outcomes 3, we have 4 different tasks there, and then I have covered the task 4 last session, and then 2 days we are going to say something about the difference between different types of finances. That's our task 1, and the sources of finance. Task 2, and then we will do one activity about the cash flow management. So these are the learning outcome 3 of our strategic finance, advanced strategic finance, and then part 2. So how we get the finance for our business. So before we start the different types of sources of finance, we need to know about the different structures of the company. So I need to say that there are the 2 basic structure of the company, what is public limited company and what is private limited company, or I can say what's a private company and what's a public company. So there is a different types of ownership pattern around these companies. So basically we will see how these different kinds of formed company can get the access of different types of finance. So normally when we see the LTD limited company, that means that there's a private company as limited by shares. That means they have their own directors, own shareholders, and then their share is not publicly funded. And when we see any company, we at the end of the company name is PLC, that's a public limited company. That means that's company funded by the shareholders, which is enlisted in the secondary market, capital market, stock exchange. So that's the difference between when we see the limited and the PLC, the difference between how the money can guarantee for their company. So that's the one idea, how can we identify the different sources of finance. But here today we are going to discuss about some different sources of finance. First of all, we need to know about the internal sources and external sources of finance. That's the basic of the financing. So internal sources, we mean that the sources that do not require the agreement of anyone beyond the directors and the managers of the business. So the retained profits, that's the profit, and then you have to keep it for the next year. That's our retained profits, are considered an internal source because the directors of the business have power to retain profits without the agreement of the shareholders. And so that's where the profits they're retained. So that's the internal, the basic source of internal. So if we retain the profit for the next year, that's the basic internal source. The running income from the company. And the finance from an issue of new shares, that's PLC, I have told you before. On the other hand, is an external source because the other public funds are coming to the company because it requires the compliance of the potential shareholders. That's the basic of internal and external, which is self-explanatory, the sources of finance. And there is again the term finance. We can discuss this later, the different types of period and term financing. So there is a finance equation, financial management and accounting equation, which is called the non-current assets plus working capital, as we know, which is what is working capital and what is non-current asset. And then that equates to the debt and equity. So application of funds, that's equal the sources of funds. That means we sourcing the funds and then we utilize the funds. That's the basic equation of the financial management and accounting equation. So that means the financial management of all matters in the business associated with the cash flow of the organization, both short and long term. So now, if I take the term financing, there is a period. So there shouldn't be a long-term unlimited period of repayable time. So definitely there is a short-term financing, there is a medium-term financing, there is a long-term financing. So over the 5 years, if we get the finance and we need to repay the money also over the 5 years, then that is called long term because it's long. Then if it is 1 to 5 years, it's called the medium term finance. And then if it within the 1 year, we get the finance and we have to repay the finance, payback, and that's called the short term finance. Normally the small and medium term business, so small and medium type of business get they are used to short-term finance, and then depends on the business and industry which term finance the company can go for. So on the short and medium debt finance or finance, there are the different names from the financial institutions. They can say there's a trade credit if it is for, purely for the trade purpose. That's a rolling contract, or the rolling facility. That's called a trade credit. Bank credit overdraft is a very, very popular short-term finance from the current account. If you have the credit facility over and over, that's called the bank credit and overdraft. If you have a term finance kind of bank loans one time, depends on the 1 year to 5 years, that's the bank loans. Debt factoring, we will discuss it, define it later. Invoice discounting, that means you have something accounts receivable in your balance sheet, in your accounts, and then you can sell that one if you need money. If you sell that early with a discount, that's called debt financing or invoice discounting. And there is a hire purchase and leasing. We will define and discuss it in later slide. The trade credit, that means the finance obtained from the suppliers of goods and services over a period between delivery of goods and subsequent settlement of the account by the resident. So that's the normal trade credit, which is very popular and very traditional and very ongoing facility for the trade company. There is another facility of the bank credit and overdraft, so that's for the period of time, or can be short time or long time. And basically for the bank accounts, they can create an overdraft facility, so they can get the money if they lack the deposit, so they can take the extra money from their bank, and then they should repay within the particular period of time, and then they can revolve this facility again and again. So now the debt factoring, raising the money on the basis of security of the company's debtors, thus accelerating payment from the customers. That's the debt factoring, and it is increasingly attractive for some points, and then many companies, not least because of the tax advantage, because if you have borrowed money, then you can pay less tax, and historically for the debt factoring, it's a low rate of interest. So it's very popular and very attractive debt financing for the company. There is another one is account receivable factoring. That's companies sell their accounts receivable to the external factoring company, and then external factoring company buy that accounts receivable amounts and proceeds to collect that amount in the future, but they pay that accounts receivable money to the original company, and they can get the discount, because if it is like 100% accounts receivables, then they can discount is 3%, so they can sell it. The company can sell it 97% of their original value, and the factoring company earns 3%. That's the difference, as they are paid by the customers. They owe that money, so they can collect the receivables money later. So, and the company can immediately sell their accounts receivable to the external suppliers to get the money for their company. So that this is the one example of the debt factoring. There is another sources of finances, invoice discounting, the purchase of selected invoices, and that's a high kind of discount and advance immediate cash up up to 80% of the face value. Sometimes some trade company, they can discount their product in the open market. That's another kind of product discounting. And then if they want to raise the money for the different purpose, of if they need some amount of money, they can discount their product to raise the money. So this kind of invoice and product discount get the sources of finance, and it's depends on the particular amount of the money, what kind of money they want to raise or they want to sourcing from that particular way. There is another way to get the finance, hire purchase. The hirer usually makes a down payment and signs the commitment. So there is an agreement with a down payment and a series of monthly hire charges over the specified period. So at the end of which a legal title passes to the user, kind of mortgage with the bank, but not the typical mortgage. It's kind of some factory or some big security they can get by the down payment, and then they will get the money equal distribution of the installments, and then when the installments will finish, then they can get the owner of that product or the property. So that's kind of hire purchase, the source of money. Lease finance is another very popular and important of sources of finance. A commercial arrangement whereby an equipment owners convey the right, distribute the right, and delegate the rights to use the equipment in return for the repayment of a specified rental over the pre-agreement and the pre-agreed period of time. This kind of lease finance is very popular in the finance market. And normally, there's a typical and conventional ways of financing is normally bank loan. If it is more than medium term loan, and then it's more than 5 years, that's a long-term loan. So normally 5 to 7 years, typical bank loan, and it's less than 5 years. If it is within 1 year, then we can call it trade credit or bank credit or overdraft facility. So finance from the banks, financial intermediaries, and financial institutions are typical for the bank loans, and because we call bank as terms of financial intermediaries or bank. So these are another popular way to get the finance, and it depends on what kind of businesses they are financing. So that's the term financing, depends on the medium, short-term, or long-term finance. So we need to know about some characteristics and the pros and cons of the long-term financing. Typically, it's nearly the 10 years, but not more than 30 years. So that's the long-term financing. So it's the period will be the 30 years. Sometimes the long-term financing will over the 30 years if it is at least finance from the government or the mortgage. That's a different aspect. The property financing can get the more than 30 years and the equal amount of money over the 30-40 years. So that's the long-term financing. It's one kind of advantage. And then normally the long-term financing within the 10 years, 5 to over the 5 years, and 10 and up to 30 years. So that's the duration of the long-term financing. So lenders are creditors whose dates are subject to specific repayment dates. That's the one kind of characteristics and features, because that's the installment should be very specific and the repayment date should be specific and equal installment, and there is a target and deadline. So lenders have no control over the borrower sometimes and most of the time, and other than the loan agreement. The rate of interest of the long-term financing is normally fixed, and sometimes it accommodates with the inflation rate. That's a variable, and then it is in the agreement, so whether it's variable or fixed cost, or sometimes it has been written in the agreement that like after 5 years or after 10 years, the rate of interest will be reviewed on the current market, because there is inflation, there is a rises of purchasing power, and the rises of suppliers. So that makes the rate of interest difference. So the rate of interest can either be fixed or variable. So most of the cases in the long-term finance, the interest is charged before the profit, and the treated as the expense for the corporation tax purpose, because you need to normally if you have debts or loans or kind of borrowings, you need to pay the less tax. So sometimes interest is charged before the profit making, and this the long-term finance is normally the financing the very secured and the fixed. Normally, capital is committed to a project for a long period during which circumstances could change or to the advantage or detriment of the borrower. So these are some characteristics of the long-term finance, and there is some special mechanism of long-term finance. And I mentioned this, a mortgage is one of the very popular method of property finance, mortgage, term loan, which is over the 5 to 10 years. There is another term finance, long-term, bonds, debentures, convertible loans, stock, and sell and lease back. Let's see. So mortgage traditionally obtained on the security of the specific property and is very popular in the UK market. There is a mortgage market, and there is all banks are dealing with the mortgage and the property, and they repay the loan by installments at a rate of interest which is fixed and variable, and then arrangement fee is a kind of percentage of loan, and the trustee is appointed to watch over the rights of the lender, and that's a legal requirement. So these are the mortgage procedures, and then that's the longest long-term loans, up to 30 years or more than 30 years, depends on the agreement. So that's a very secure and obtain the specific property for this purpose of loan, mortgage. Term loan is negotiated on the security of fixed asset. Depends on what kind of security the borrower will provide to the lender, and then it can be repaid at the rate of interest which is normally fixed for the term loan, and then it should be equal amount of repayments and installments, and information of past financial and operating performance is subject to supply to the lender, because lender needs to see the previous history of the borrower. Lender charges the costs of the investigation and arrangement of the loan to the borrower, normally the two-person. If the financial institution or any other lender, they want to proceed some lending facility to a particular type of borrower, they need some lending supervision fees and costs of investigation for the loan and for the borrower. So there is another way to raise the finance, that's the bonds and debenture. So a long-term contract in which the bondholders lend money to a company and then pay and bond owners a series of interest known as a coupon payments. There is a maturity of the bonds, so you can buy the 10 years, 5 years, 15 years bond from a particular company. It's not like unlisted stock exchange shares. It's a bond you can buy directly from the company, and they are going to pay a series of interest to the bondholders until the principal will be repaid until the bond matures. And the maturity, the bondholder receives a specific principal sum. That's the one way to raise the finance for the company. And normally the bond maturity time is 7 to 10 years, and that's regarded as IOU. So this IOU, the bonds, can be traded in the secondary market, that's the capital market, through the securities dealers, the brokerage, the stock exchange. The original investor doesn't have to keep the bond until the maturity date. So bond can be traded in the stock exchange market if he wants to sell in the stock exchange. And debenture is another kind of secured bond and fixed or floating charge against the firm's assets. And bond investors may be willing to lower the coupon payment. They demand it, they can reassure that their money will not be exposed to a high risk. And then the debenture can place risk reducing the restriction on the firm. So that's the different types of secured bond, which is fixed and floating charge against the firm's assets. There is a risk reducing restrictions regarding the borrowings and lending formalities. So limits the further debt, definitely, and there is a certain level of dividend level. The company needs to pay the dividends, and limits on the disposable of assets. And if somebody wants to see or invest the company, or if the company wants to raise their money from the secondary capital market, so lender can check their financial performance from the public accounts, and they can assess the financial ratios, they can assess the dividend level, the percentage, and they can see the debt in the balance sheet. Then they can see the risks of the lending money. There is another way to raise money, convertible loan stock. That's a different bond, and then which started as a bond, begins life as a bond, which is debt, and usually pays a lower rate of interest. Normally the bond has got a high rate of interest, and debenture as well. But the convertible loan stock usually pays a lower rate of interest, and holders have the options to convert their stock to a fixed number of ordinary shares at a predetermined rate. And then usually after several years between the issue date, the beginning date of the convertible loan stock, and the possible conversion date to ensure that interest rather than dividends will be payable in the early years. So that's the other way to bypass the bond and debentures. If the borrower wants to pay the lower interest rate, they can create the convertible loan stock. So there is another popular way to get the finance, sale and lease back. That is, you can sell as a borrower, sell assets to the financial institution, and the seller gives up the ownership rights to the property, and then arrange a lease the premises from the new owner. And the transfer the ownership with the retention of rights to use for the specific period. That means it's not kind of like the mortgage. So for if you fail to repay the property, then the lender will take the property. But the sale and lease back is kind of close to mortgage facility, but it's not a transfer of the ownership with retention of rights to use for a specific period. So for example, 20 years, 10 years, the seller gives up their ownership rights to the property and then arranges a lease of the premises from the new owner. So that's kind of a different kinds of arrangement of sale and lease back. And then, yeah, we can understand the accounting equation of the that's working capital, and our debt, current asset, non-current assets equals our debt and equity. So debt and equity equals non-current assets plus working capital, and the equity defined as a contribute to a company by its shareholder, most of the cases, and that's the reference from the book. So contributed to a company by its shareholder, that's the ownership, that's the equity. And then the key feature of the equity capital that owns the company, or the proportion, there are no fixed charges, no repayment is required, directors have greater control over the amount and timing, and there is a listed company, and the stock exchange market can easily be disposed anytime if they want to dispose their shares, or they want to sell their shares, they can do this anytime in the stock market. And there is a disadvantage of the equity capital. The public issue is sometimes very expensive, and issuing new shares to new shareholders sometimes dilutes the control on the management. And then some dividends not always a tax deductible, but you need to pay the tax. And then the higher proportion of the equity can increase the cost of capital. So these are the disadvantages of the equity capital. If you want to raise the money, the big chunk of money from the secondary market or within the company by paying the dividend. So these are some against things. So equity finance can be arranged by the reserves. That's a return on earnings and some reserves. Venture capital. So if some borrower wants to do the merge with another company and then collaborate by a consortium or make a condominium, that's the venture capital. And private placing, the alternative investment market, quoted companies, we will discuss it in the next slide. The reserve means internal finance, including retained profits. You are not distributing the profits as a dividend to your shareholders. That could be retained for the next years, and that is your retained profit, and then providing the main source of the new capital for companies. So this is less costly, and then issuing shares and then ready-made and available in the company, and the free source of finance and far more attractive than other loans. That's the reserves. And then venture capital provide equity capital to small and growing companies, foster the development of the small business for a variety of reasons. And then this is very nowadays is a very top and hot topic for the venture capital research and for the research development and then R&D. And then venture capital may develop a new source of supply for financing. And then venture capital are very attractive to gain access to a new market. So if it is a 2-3 different geographical location, the 2-3 different located company can raise the money for the unique product, and they can make the global market. So that's a very easy to collaborate and make a consortium to raise the capital money. There is another way to source the finance of private placing. There is a well-established companies can widen their shareholder space without going for a stock exchange listing, kind of venturing, and arranged through a stockbroker or issuing house which buys and shares and then places them with clients, kind of bypass the short stock exchange market, or they can directly go with the brokers and dealers to the another placements. And there is another alternative investment market, provides a market for the shares of companies that are too young or too small to qualify for or benefit from as a full listing, and the alternative investment market. So if the capital market bypass and then the borrower can raise the money from the alternative way. So that's the alternative investment market. And then if any unquoted company may require such a large amount of new capital, it may decide to go public by issuing shares through the stock exchange. That's the quoted company, normally the secondary capital market. And then if that company must be listed in the stock exchange, because we are living in UK, so here the London Stock Exchange is a very strong capital market in the world, and there is some criteria and then some formalities need to be cleared from that company. That company must be meet some certain criteria to trade on the stock exchange market. So that's a quoted company. Quoted company means that the companies are listed in the share market, and then company can raise the shares, and then the company can buy and sell the shares to take that money in for the company. So we have discussed over the different kinds of sources of finance. Now we will think, after finishing this lectures, what are different kinds of advantages and disadvantages of each of the sources of equity finance. So if you revise the slides when I finish, and then if you revise these slides, you can think about what the different kinds of pros and cons of these sources of money, formula internal sources, what are the advantages and disadvantages. For example, external sources, for example, mortgage, lease finance, sell and lease back. So what are the different kinds of advantages and disadvantages of these different kinds of equity finance? So we can see in the internet what is the alternative investment market and what is the stock exchange market. Typically, you can see what is the criteria and the process to obtain a quotation on the London Stock Exchange market. Regardless, you can see what is the process of IPO, initial public offering, if you want to raise the money from the public shareholders. So what's the primary market and what's the secondary market, and what's the money market and capital market are associated with these sources of finance. So you can have a thought, and you can have something mind mapping for your own knowledge. So what are the different kinds of advantage and disadvantage of different sources of finance, and you can have some idea about the secondary capital market, which is stock exchange market, and what is the procedure to get the share issues or the listing in the company to the stock exchange. So that's your thoughts. After finishing this lesson, you can have a look through the internet, or you can see some brochure to check these thoughts. Now we have another topics, cash flow management, and we will do one very interesting activities. I'll show you how you manage your cash flow and how you decide your cash flow, and what are the different heads of the cash flow management. So normally cash flow is one of the most vital elements in the survival of a business. This can be a cash flow figure that could be positive or negative, or which is obviously a most undesirable situation if it is negative. And the aim of a cash flow statement is to assess the company's ability to generate positive cash flows in the company. Normally, cash flow means cash in and cash out, because that's how many cash are coming, that's the products are selling, so the company is receiving the money from the clients, that's the revenue. So how many revenues are coming, and then how many expenditures are going, and that's the difference is cash flow. So to assess its ability to meet its obligation to service loans, pay dividends, etc., to assess the reasons for difference between the reported and related cash flow, that's the aim of the cash flow statement, and to assess the effect of its finance of major transaction in the year. So therefore, the cash flow statement shows different kinds of changes in cash and cash equivalents rather than working capital. So cash flow is not a working capital. Working capital is the capital, that's the running capital which accelerates the business, but the cash flow is the revenue and the difference between the expenditure, day-to-day cash flow, weekly cash flow, monthly cash flow, which shows the company's cash position normally. So normally, if we see that these are the normal table of the cash flow, that's a forecast that estimates what the cash inflows into the bank account and outflows out of the bank account will be. Normally, the company running the cash inflow and flow with the help of the bank accounts, and the result of the cash flow forecast is an estimate of the bank balance at the end of each period covered. Normally, this is for each month. An example of a simple cash flow forecast is shown below. So this is the table of the cash flow. Normally, this is a 6 month cash flow. Cash at start of the month is the beginning of the cash position. That's if we think about the thousands, that's a 25,000 of January. On the February beginning, that's 20,000. This is the beginning, and that's the inflow. That's the revenue. That's the expenditure outflow, and the difference between outflow and flow, that's the net cash flow. And then you can check your cash and your net cash flow. When you make the difference from your cash at start of the bank and the net cash flow, then your cash at the end of the month, that's your position. So this is the very basic table of the cash flow. And then you need to forecast your cash flow position. You can predict your cash flow over the period of time. So this is the example of the cash flow forecast. So normally, sorry. So normally a business uses a cash flow forecast to identify the potential shortfalls in the cash balances. If the cash forecast shows a negative cash balance, then the business needs to ensure it has a sufficient bank overdraft facility. Sorry. And again, if it is a trading company, normally the cash flow requires a trading company, and they need to see their revenue, expenditures, costs, and profits, which meets the break-even point and margin of safety. So a business uses a cash flow to analyze whether the business is achieving the financial objectives set out in the business plan. Definitely there is a financial plan, and there is a revenue and expenditure plan, and there is a profit plan over the period, over the 5 years, which will almost certainly include some kind of cash flow budget. If a business runs out of cash and is not able to obtain a new finance, it will become insolvent and bankrupt. So that's the need of the cash flow forecast for the company. So, and the key reasons why a cash flow forecast is so important is that these are the very key points. So, because you need to identify the potential shortfalls in cash balance in advance. Think of the cash flow forecast as an early warning system. So if you think there's a negative cash flow, that will be the alarming position for the business, and this is by far the most important reasons for the cash flow forecast. And then the company who are producing their cash flow forecasting, make sure that the business can afford to pay these suppliers and employees, because the suppliers are providing the materials. So company needs to repay their raw materials invoice money and the wages of the salaries for the employees. So suppliers who don't get the paid well soon stop supplying the business, and that will distract the business. And is it even worse if employees are not paid on time? That's the one very significant situations. If the employees are not get paid, that will affect the business. Spot problems with customer payments. The cash flow forecast can spotting out the problems with any kind of customer payments or repayments, because it's preparing the forecast to encourage the business to look at how quickly customers are paying their debts. So this is not really a problem for the business like retailers normally, that make most of their sales in cash credit or at the time of sale. So normally if there is a problem in the cash flow projection, company can spot out the customers' problems. So they can manage the discipline of the financial planning. See if the core cash flow forecast is well designed and then very well managed in terms of process, and then they can prepare a good business budget on the basis of a cash flow forecasting. And then again, external stakeholders who are associated with the business, such as banks, may require regular forecast. Sometimes when some bank requires a cash flow statement from the company when they disperse for their next installment, when they disperse the long-term loan, they require the cash flow statement, what's going on inside in the business. So if the business has a bank loan, the bank will want to look at the cash flow forecast at regular intervals. So the company must be updated with the cash flow projection and statement, running cash flow and the projected cash flow. So if the running cash flow will show what's happening in the business, and the projected cash flow will spot out the problems with any kind of payments and revenues. So therefore, a cash flow forecast is a projection or budget of how the cash in bank is expected to move. because nowadays people don't do the cash in hand. They always do the cash in bank because it's a financial technology era. So the cash flow forecast is a projection or it's a prediction or a cash budget or how the cash in bank is expected to move in terms of revenue and cost. And it helps to prepare a financial report. And these are the very useful because profit is only one indicator of a business performance. And that's the objective of the business mostly, to maximize the profit. But the business needs to generate cash to satisfy its bankers as well as the owners, suppliers, and the stakeholders who are related with the cash, and that it can repay any kind of debt. So sometimes the non-accountants, so that's the management account can predict their cash management, cash flow, and the cash budget. But the non-accountants should ask why there are increase or decrease in cash recorded in the period. So sometimes there is a fluctuation of the cash ups and downs. So non-accountants can ask why these are the big deviation. Sometimes the interested party who is not have that accounting background can think what are the main items that have caused it of the fluctuation of the cash ups and downs, and then what the different kind of short of cash in immediate future, or are they going to short of cash in the immediate future, and then will the bank support an extension of the overdraft facility, and then can the company can borrow some funds from elsewhere? Might the company need to borrow some long-term basis or short-term basis? These are the questions associated in the stakeholders or external or internal. Anyone can see on the basis of the cash flow projection. So these are the typical cash flow management and then accounting system. So if you have a bank overdraft facilities to 20,000, that's your, and if your opening balance is 12,000, and then if the company has unpresented check, that's account receivables, and then 3,000, that's the total balance is 15,000. That's the starting position to check the cash flow, and then to control the credit, because the company has got the 20,000 overdraft facility. So if you have a bank balance of 15,000, so you need to check whether it's credit control and what's the position of the bank overdraft facility on that moment. So receipt paid in 2,500 and then balance 12,500, and that's the negative figure. So you can see that this is the negative figures, and the closing balance is 90,500, whereas our bank order facilities is 20,000. So that should be the check and balance. One one company can check his cash flow projection and management and what's going on happening in the company. So these are the dates, and these are the demand draft and wages due. So these are the non-discretionary amount. There is no point of discretion. So these are the typical cash flow projection. So you have the company has got a 20,000 overdraft facility, and the closing balance is 19,500. So they can check and balance whether that closing balance can compensate with the overdraft facility. So cash flow forecasting comments with monetary position, cash balance, debtors, creditors, and then projected income statement adjusted for timing difference, and then sometimes 1 month's credit, and then that's the sales invoice and receive. That's the money coming in inflow, and then there is a non-depreciation shouldn't count in the cash flow management, and then there's some non-income statement items such as loan repayments, capital items should be added in the cash flow. That's the typical calculation of the cash flow. So for example, if you have income and if you have expenditure. So when you add all incomes and when you deduct all the expenditure from the income, then you have the monthly profit, and then it affects the cash flow. So when you have all receipts and then when you have all payments, that's your cash flow. So when you get the all receipts and your all payments, when you differentiate between the receipts and payments, then that is your cash flow, that is A, and that's B. So when you deduct B from A, then you will get your cash flow for each month. And then your opening balance is some amount, which is here is negative. And when you add your cash flow plus opening balance, that's your closing balance, bank balance. So that's the cash flow position of the company. We will do one exercise here, which action station, and then I'm going to open Word document for you, and then we will calculate how we calculate the cash flow and cash management. So these are some information. So there is a datus on the date, and then there is 16,000 payable, which is 2/3 within 30 days, and the balance within 60 days. So this needs to be done by the management accountant or who is doing the finance of the company. He or she needs to check what's the income and receipts, cost and expenditure going on in the business, and then he or she needs to do the cash flow position of the company. So these are the one action station company, and we are projecting next year cash budget, and then there's some things that happened in this year. So datus 60,000, and that will be payable 2/3 within 30 days, the first month, and the rest of the second month. So the 60 days is 2 months, first month, and then within 60 days. Creditors and 50,000 payable within 1 month. Opening unreconciled bank balance 40,000 overdrawn, but there are unpresented check to suppliers. So let's see how we do this table. So 1, 2, 3, datus, creditors, and opening unreconciled bank. And then we have some sales, purchase, and overheads and capital equipment, which is per month and 60 days for invoice. Overhead 2,000 per month, payable monthly. Capital equipment to be purchased February on 10,000 in 1 month credit. There is a refund of corporation tax due on 10,000, and then there's a wages and salary depreciation 12,000, and we are taking this depreciation. And then overdraft facility 64,000. That should be included in your bank, and then we can use to reduce this. So sales profile 30,000, purchase 20,000 from these boxes and wages all through, and then we are going to calculate 6-month cash position, I think. So January, February, March, April, May, June. So first off, so 60,000, 2/3 within 30 days payable, and then balance with 60 days. So 2/3 is 40,000, and the balance is 60 days. That's the 30 and 30, so that's 20,000. Sales all through from March to June 30,000, and tax refund of corporation is 10,000 on the month of April. So that's total income, that's total receipts. So if we add total receipts of every month, because we are doing monthly cash flow projection. So when we add all of these, we will get the total receipts of each month. So if you add this will a total 190,000, and if you add these all, that will be also 190. So these are the total receipts. Now payments. On the payment side, because we need to pay 50,000 to our creditors, there is information within 30 days. So that's our payments, creditors, and purchase all through 20,000. Wages we need to pay to our employees 5,000 all through the year. Overheads 2,000 all through the years. There is a capital 10,000. Capital equipment is to be purchased in February for 10,000 in 1 month's credit. So it will go on the 1 month credit because the capital has been purchased on the February in 1 month credit, then it will go, the payments will go in March. So these are our payments. Now, if we add all the payments, then we will get the total payments. So of each month, if we add all of these, if you do it in Excel, you will get all the total of this. So this is January, February, March, April, May, June, and that's total. The total of 2,200,000, that's total, and this total also 2,200,000. So these are our total receipts, and this is our total payments. So what is the cash flow now? So cash flow is our total receipts minus our total payments. So if we minus 57,000 from 40,000, that will our minus 17,000. So 20,000 minus 27,000, that's minus 7. This is our cash flow. This is all through our cash flow. Now, we need to calculate our opening balance and closing. So we have our opening balance here. Now we have to calculate our closing balance and the opening balance. So opening balance here, that's 50,000, came from unpresented check. If you see there is an unpresented check. Opening on unreconciled bank balance is 40,000 overdrawn, and there are unpresented check of 10,000. So that altogether 50,000. So 50,000 is our opening balance. Now we have a cash flow here. So we have our cash flow here, and then we have our first month of opening balance. So opening balance is also equal to our overdrawn and unpresented check, but normally when we do our calculation of the opening balance, we can take the opening balance plus cash flow for the second month. So if you take the opening balance for the January, and if you take the cash flow from the second month, then we will get the opening balance for that month. That means opening balance of that's our closing balance of the January, our opening balance of the January. So that's 50,000 plus cash flow, that will our opening balance of our February. So this plus this will give you the opening balance of the second month. And again, if you have this opening balance 67,000, then you have a cash flow of the next month, and you will, if you add this, that will give you the opening balance of that month. So that means opening balance of the previous month, cash plus cash flow of this month will give you the closing balance of this month. So this plus this give you the opening balance of the next month. So when you add this and this, it will give the 67 of the opening balance of your February. This plus this will give you the opening balance of the March. This plus this, that means opening balance plus cash flow. That's the formula. Opening balance plus cash flow will give you the opening balance of the next month. But here, when you finish your opening balance, the total will be the beginning of the opening balance. That's your opening balance. That's not the total. So this should be your opening balance at the end of the day when you calculate your whole 6 months opening balance. Now, closing balance is cash flow plus your opening balance. So this plus this, your closing balance. This plus this, your closing balance. This cash flow plus opening balance is your closing balance. Cash flow and opening balance is your closing balance. And this is your last closing balance. So that should not be your total. So closing balance is your ending balance, and opening balance is your beginning of the balance. So this is one kind of cash flow estimation. So you have some information, and now as a manager, financial manager or management accountant, you need to do some cash forecasting on the basis of this information, and then you will need to produce total receipts and total payments table, and then you need to produce a cash flow statement of the previous year, and then you can project for the next 6 months or 1 year projection of your cash flow and what amount of overdraft facility you need. So here I can show you that you have overdraft facility 64,000. So if you have overdraft facility 64,000, and then you see, so your cash position is minus, your cash position is 674. So if you have overdraft, here is better. So if you have overdraft facility 64,000, that equate, so that can minimize. So here you can increase your overdraft facility, and then you can negotiate with the bank. So you need a more than 64,000 overdraft facility here, and then that's lowering down here. So when you check your opening bank balance and closing bank balance on the basis of cash flow, then you can manage your sources of finance, short-term financing, what kind of overdraft facility, what amount of overdraft facility you need for the business, then you can check and balance. So that's the most important aspects why you are projecting cash flow for your business, and then you can justify what amount of overdraft or credit facility you need for the business. Because the more you take the amount of money from the financial institution, the more you need to pay the interest rate, and that incur the cost of capital. So that's why you need to check and balance what is the predicted cash flow and what's happened in the cash flow position in the business. So that's the activity, and then you can follow some cash flow management activities from the website or from our manual. So normally we ignore the depreciation. So there is a depreciation of 12,000, so we didn't add that depreciation amount in the action stations cash flow projection. So we didn't do anything on the depreciation amount. So when you do the cash flow projection, you always avoid the depreciation amount for cash flow statements. So cash flow management and the sources of finance and financial management is always there is a need for internal controls. And these are the management responsibilities for internal controls. And internal controls is the process which should provide reasonable assurance about the achievement of an entity's objectives with regard to the reliability of the financial reporting. That's the validity and reliability and effectiveness and efficiency of the operations of the cash and the money management, and compliance with the applicable laws and regulations, definitely. And there is a guidance on internal control, which is standard Turnbull called. Directors are always required to make a statement that they have conducted a review every time. It's a periodical review of the effectiveness of the internal controls of a company. And there is always an important of systems of internal control mechanism, which is managing the risk assessment in the company and achieving the corporate objectives of the business. An effective internal control system always helps to safeguard the shareholders' investment. The more you have a good control mechanism in the business, the more you have a good dividend policy for the shareholders. So that's the normal norm. So, and this is a safeguard if you have a good, effective control, internal control system, and then the safeguarding the cash, the money management. And because finance is a science of a money management, and this is a kind of corporate asset if it is in terms of big and long-term finance, and that can assist in ensuring that operations are carried out effectively and efficiently. So that's the guidance of the internal control to make sure the management responsibilities are all taking in a good way to control the business and other things. So there are key aspects of internal control for the managing the money. The environment, definitely the control environment, that should be make sure by the management and the owner of the company, the risk assessment process, how the risks are assessing, the information system, everything, the reporting, the channel, chain of command, the structure of the company, the hierarchical level of the company, that's a good, and the key aspects to control internally the whole things, and the activities, the control procedures and monitoring of control. These are the key aspects of internal control, to check and balance of the cash management and the overall the finance management. So we have said about the cash budget, cash management, and that contains the itemization of the projected sources and uses of cash in a future period. And this budget is used to ascertain whether company operations and other activities will provide a sufficient amount of cash to meet projected cash requirements. And if it's not, then the management or the owner of the company must find additional funding resources. And the cash budget comes from the several ways, and the results of the cash budget are used to financing budget, itemized investments, debt, and both interest income and interest expense to compensate. The cash budget is comprised of two main areas, with sources of cash and uses of cash, which is receipts and payments. And then we have discussed the different heads of the sources of cash, that's the income, that's the receipts, and then the payments, the uses of cash, that's the utilization of cash. We have discussed in our tables, and we have done one activity so far. And then we know what is the good characteristic of the budget. Definitely we need to know the good budget is characterized by the following: participation, transparency, and involve as many people as possible in drawing up a budget, comprehensiveness, and that's embrace the whole organization. It must be a standard based on the establishment and standards of performance. There should be a flexibility sometimes because there is an increase or decrease of the cash position and financial position. And there is always a feedback, either top to bottom or bottom to top layer. So if they take the feedback of each department and they constantly monitor the performance of the revenue, receipts, and payments, that will give you the good character, good proposition of the making a good budget. And the analysis of cost and revenues, that can be done on the basis of the product lines, if it is a goods and service company, and the departments or cost centers. So I have showed you, these are the different heads of the cash budgets, and then this one example of the Emerson manufacturing. So you can take from the main slides, and then you can have a look when you are making the thoughts of the different kinds of sources and then different kind of cash budgets, predictions, and you can see the different heads of payments and receipts. So, and then steps in preparing cash budgets, the same way. I have done one activities with you. Again, you can follow this tape, how to prepare a cash budget. Step 1, step 2. Step 1 is set out a pro forma cash budget by months a month. These are the 3 months. This is a 3 months cash budget, and you can sort out the different kinds of cash receipts and debtors. So these are the receipts and these are the payments. So you need to think, and then you can play with the numbers in this table. So these are the different steps, and then you can follow these steps, and then you can go with the action stations, case works, and then that action station case works already in the Moodle area. You can see that and download that action station Word document, and then you can check and balance how can you put the figure on that action station's case, and then you can put that figure into these different months. So you can take that example with action stations. So I'm giving you one homework. When you finish this lesson, then do some homework with your pen and page. So review the principles of cash flow and cash budgets for forecasting, and then what are the pros and cons if it is a cash flow, because cash flow management and cash budget, you need to know as a financial manager, so what's the receipts are coming from the company and what's the receipt payments are going from the company. So, and the review of the action stations, you can check with that pro forma, the last slides, and you can put that figure from the action stations and then answer if not completed by your individual practice, and let me know. This is my email address, and you can email me, and you can call to the University office 9 to 5 working day, or you can email me if you have any query. So all particulars are has been uploaded in the Moodle area. That's our level 7 strategic advanced finance for strategic managers. So you can have that information from the Moodle, and then you can have these slides from the Moodle area. And if you have any questions, again, you can email me anytime, then I can pick up your email anytime, and then I will reply you back as soon as possible. So that's all. So enjoy your study. Have a good sleep, and well, good luck. Thank you.